Hello now my curious friends, welcome to the channel where we talk accounting and finance. Today we solve a common puzzle. When do you put goods on your balance sheet and when do you take them off? The answer often depends on Incoterms, an internationally accepted set of rules which define the responsibilities of sellers and buyers in the delivery of goods. By the end of the video you will know what the main terms mean, when the buyer recognizes inventory, when the seller derecognizes inventory, and how to handle goods in transit. First, what are Incoterms? Incoterms are standard trade terms published by the International Chamber of Commerce. They explain who pays for transport, who handles export and import formalities, and where the risk transfers from the seller to the buyer. But there is an important note here. Incoterms do not say who owns the goods legally. They do not decide revenue timing by themselves. In accounting, we look at control as it is defined in the contract. Contract defines the transfer of the ownership. But the control often aligns with the transfer of the risk in accordance with Incoterms. So, these terms are a useful guide. There are in total 11 terms. Yes, it's a lot. Not that easy to remember and quite easy to get lost. So, in the end we will focus on those you would see the most often in real life. These 11 terms are typically divided into 4 groups based on the first letter of the term, which are E, F, C and D, you will see in a second, with the seller's obligation increasing from group E to group D. So here come the terms, one by one. First one, Ex-Works or EXW. The seller makes the goods available at his premises, and the buyer picks them up directly at seller's site. Risk transfers at the so-called seller's gate. This is the lowest risk for the seller, as the seller is not responsible for transportation, insurance or customs clearance. Goods are gone and forgotten. The next one is Free Carrier, FCA. The seller delivers the goods to a named carrier at a named place, and the risk transfers there. So, now you have more exposure for the seller, because if the goods are damaged during the transfer to the carrier, the seller may be responsible for that. The next is FAS, Free Alongside Ship. Here the seller delivers goods alongside the vessel at the port of shipment. The buyer is responsible for loading, main carriage and insurance only from that point. Again, more risks for the seller as the goods stay longer under his control. And a note, this term applies only to the sea and inland waterway, as the name suggests. The next term is FOB, Free On Board. Here the seller delivers the goods on board the vessel at the port of shipment. Risk transfers when the goods are loaded on the ship at the port of shipment. This term also applies only to the sea and inland waterway and is also one of the most popular terms in the trade. Now comes CFR, which means cost and freight. The seller pays the carriage to the destination port, but the costs and risks transfer to the buyer already once the goods are on board the vessel in the port of shipment. So, here we have a hybrid situation and a bit of a mismatch between the timeline for covering transportation costs and transfer of risks. Again, this term applies only to the sea. Next one is CIF, which means cost, insurance and freight. It is similar to CFR, but the seller also covers insurance for the buyer's benefit during the transit. Risk also transfers at loading on the vessel. And it also applies only to the sea. This term is very popular too. The next one is CPT or carriage paid to. The seller pays for carriage to a destination point, but the risk transfers already when the goods are handed over to the first carrier. More costs for the seller. And next one, CIP or carriage and insurance paid to. Again, similar to CPT, but the insurance paid by the seller for the buyer's benefit. The risk transfers to the buyer at the first carrier. Now we move to letter D. DAP or delivery at place. Here the seller is responsible for the costs and risks until goods are delivered to the named destination, but not unloaded yet, and import duties not cleared. The risk transfers to the buyer upon arrival at that place. Next one, DPU or delivered at place unloaded. The seller delivers and also unloads the goods, and the risk transfers when the goods are unloaded at the named place. And the final one, DDP or delivered duty paid. The seller covers all risks and costs until delivery at the destination, including unloading and clearing import duties. The risk transfers on delivery to the place of destination. So, 7 of those terms apply to any mode of transportation, while the 4 ones only to the sea and inland waterway transport. A lot, right? And now, how it all works in the world of accounting. But before we move on, if you find our lesson useful, please take a moment to hit the like button and subscribe to our channel. And thank you for being with us. This is very important to us. So, in practice, the buyer recognizes inventory and he obtains control over the goods under the contract. The seller derecognizes when he transfers control. Since control usually transfers where the risk transfers, the Incoterms transfer point is your first checkpoint. But please always confirm the contract and any side letters. Let's have a detailed look at 5 most common terms with the link to our Apple business. These terms are Ex-Works, free on board, cost insurance freight, delivered at place, and delivered duty paid. We start with EXW with the transfer point of seller's warehouse. Let's buy apples on EXW Barcelona for $5,000. We send our own truck to pick them up. Our truck is very reliable and cheap to operate, and we want to save money on delivery. Here, the risk and control transfer at the seller's gate when the pallet of apples is made available to us. What is our journal entry for the pickup of apples? Debit inventory raw materials 5,000, credit accounts payable we will pay later 5,000. Seller's entries at pickup will be debit accounts receivable 5,000, credit sales revenue 5,000. And now the removal of inventory, assuming they are selling apples at a profit of 2,000. Debit cost of goods sold 3,000. Credit inventory finished goods, apples are finished goods for them 3,000. Under EXW we will bear transport risks and risks for the apples from the gate. So we will usually recognize inventory when the truck leaves the seller's site. It's not yet in our warehouse, but already belongs to us. Let's now look at FOB. We buy jars for $10,000 FOB Shanghai. Here, the risk and control over the jars will transfer when the jars are on board the ship. The moment the jars are loaded, at on-board date, we record the following. Debit inventory raw materials 10,000, credit accounts payable 10,000. Seller enters for the sale, debit accounts receivable 10,000, credit sales revenue 10,000. And for the removal of inventory, debit COGS 6,000, credit inventory 6,000. And because the seller is now responsible for the delivery of the jars on board the ship, they will recognize transportation costs. Debit transportation costs, let's say 1,000, credit accounts payable 1,000. Even if the ship sails a week later, control passed at loading, we will show the jars as goods in transit in our inventory from that moment. Now let's have a look at CIF. We buy sugar CIF Rotterdam for $500. Seller pays freight and insurance, but risk still transfers to us at loading in Rotterdam. Accounting will be the same as for FOB. The insurance is for our benefit but doesn't change control. Debit inventory raw materials 500, credit accounts payable 500. Seller enters for the sale, debit accounts receivable 500, credit sales revenue 500. And in addition to COGS and transportation costs, the seller will need to record insurance cost. Debit insurance costs, let's say 100, credit accounts payable 100. Now DAP. So we bought apples, jars and sugar and produced jam. We sell the jars of jam to a retailer DAP Paris. That means we carry goods to the customer in Paris and the risk will transfer on arrival at their site. We will keep the inventory on the way. The jam is still in our inventory while on the truck. We derecognize it only on arrival in Paris. When the jam arrives in Paris, our journal entries will be debit accounts receivable 8,000, credit revenue 8,000, debit cost of sales 5,000, credit inventory 5,000, debit transportation costs 1,000, credit driver salary payable 1,000. And the last term, DDP. Very similar to DAP, but we will need to also pay the import duties. That will be an additional accounting entry for expenses. Debit duties and import taxes expense 300, credit cash 300. So, what have we learned about goods in transit? When control has transferred but the goods are physically on the move, the buyer shows goods in transit inside inventory, and the seller derecognizes from inventory. Freight status does not change who recognizes inventory, it only changes who pays the carrier. Now, a few common mistakes. The first one, confusing ownership and risk. Risk does not always mean ownership. Make sure you check the sales contract. Number 2, ignoring partial shipments. Recognize control for each batch when its own transfer point happens. Number 3, forgetting import clearance under DDP. If the seller is responsible for import, the recognition happens only at the final place of delivery. The next one, not showing goods in transit at period end. If control has transferred, include them in inventory and disclose where helpful. And the last one, failing to specify the place or port. And now the very last summary example. We buy jars FOB Shanghai on 28th December for $10,000. They are loaded on a container ship that day. The ship departs on 30th December. Our fiscal year end is the 31st December. The vessel arrives on the 12th of January. On the 28th of December, risk and control passes to us. Therefore, we recognize inventory on the 28th of December at $10,000 and show goods in transit at year-end. We do not wait for arrival. The seller also derecognizes on the 28th of December and records the sale if other revenue criteria are met. Okay, we are through the Incoterms and let's summarize the lesson. There are 11 Incoterms with the obligations of the seller increasing as you move to the next one. Read the Incoterms and find the exact transfer point. Confirm the contract and the title clauses for the proper definition of the transfer of the control and ownership. Recognize inventory when you control the goods. Show goods in transit if control passed, even if they have not arrived yet. So that is briefly, or not really very, how Incoterms guide inventory recognition and derecognition. Thank you for watching. If you enjoyed this lesson, hit like, subscribe and ring the bell so that you don't miss the next lesson. See you soon and keep those debits equal to your credits.